Imagine you're strapped into a rocket. The G-force is just pushing your face back. The speedometer's hitting numbers you've honestly never even seen. And everyone around you is just cheering.
Right. Total euphoria.
Exactly. But then, without any warning, the engine's just cut out. You're in free fall. Like half your fuel is instantly gone.
Yeah. I mean, you go from popping champagne at the absolute summit to bracing for a catastrophic impact, all in the span of like a few months.
Right. And if you were a passenger on that rocket, your first thought wouldn't be, oh, wow, this aerospace engineering is really maturing.
No, you'd be thinking, this is a literal death trap.
This is a death trap. Right. So today, we are cutting straight through the absolute noise of the current crypto hype cycle. We want to know what the data actually says about the future of finance.
Because the narrative out there is incredibly messy right now.
It's so messy. So to figure this out, we've got a massive stack of recent market reports, on-chain data analyses, and institutional forecasts, straight from the front lines of the 2025 and 2026 financial landscape.
Yeah, we're looking at K33 research, A16's data from the World Economic Forum, institutional filings, you name it.
And the goal for this deep dive is to answer the trillion-dollar question. Is this space a lasting economic boom, or are we just living inside a massive historical bubble?
Because looking at the raw surface numbers, the whiplash is undeniable.
Oh, it's totally insane. Just look at last year. In 2025, the total crypto market hit a record $4 trillion.
Right. Bitcoin peaked at an all-time high of $126,080.
But then, by early 2026, $2 trillion of that value was just wiped out, like gone. Bitcoin dropped below $70,000, and the crypto fear and greed index plummeted to like post-FTX lows.
It was a brutal correction.
Okay, so let's unpack this for a second. With half the entire market evaporating in mere months, how is this not just the ultimate global casino?
Well, that's where the data gets really counterintuitive, because what looks like a chaotic bubble on the surface is actually, according to the analysts, a foundational technology going through a very painful but necessary maturation.
A maturation. Losing $2 trillion signals market growth.
I know, it sounds ridiculous. But let's look at the K33 research report. It shows that despite the crash, 2025 was actually Bitcoin's least volatile year in history.
Wait, least volatile? Seriously?
Yeah. The daily volatility dropped from 2.8% in 2024 to 2.24% in 2025.
Okay, so it dropped to 2.24%. What does that actually mean in context?
It means that in a landmark shift, Bitcoin was actually less volatile than major tech stocks like Nvidia.
Wow. Less volatile than Nvidia. But I have to push back on this math a little bit.
Go for it.
How can a market that lost $2 trillion be considered mature or even less volatile? It feels like saying, a teenager's getting more graceful right after they trip and fall down a flight of stairs.
That's a great way to put it, actually.
Right. Like, sure, maybe it was a clumsy fall, but they're going through a growth spurt. Their underlying bone structure is finally solidifying, even if they are still moody and uncoordinated.
Exactly. Yes, the bone structure is solidifying, but they're also, to use your teenager analogy, finally getting a job and reacting to the real world.
Okay, explain that.
What's fascinating here is that the Wild West days of pure crypto-native hype, where a single tweet from a tech billionaire could crash the entire ecosystem by 50%, those days are ending.
So the market isn't reacting to memes anymore.
Right. The price movements we saw in the 2025 to 2026 cycle are increasingly tied to traditional macroeconomic factors.
Like what?
We're talking about interest rates set by central banks, geopolitical risks, inflation data. It's proving it is behaving like a conventional financial asset class.
Okay, so the mechanics of the market have fundamentally changed. The asset is behaving less like a casino chip.
Exactly.
But that brings up a really crucial point. If it's acting less like a casino chip, what are people actually doing with it?
That is the big shift, from Wall Street speculation to Main Street utility.
Yeah, because the A16 State of Crypto report has a stat that completely stopped me in my tracks. Global crypto ownership hit 741 million people in 2025. That's a 12.4% increase.
Which means 1 in every 11 people on Earth holds some form of crypto.
1 in 11.
Yeah.
And Bitcoin alone has 364 million holders.
But here's the catch from that A16 report. Out of those 741 million holders, only 40 to 70 million are actually active on-chain traders.
Wait, really? Only 40 to 70 million?
Yeah, the vast majority are just holding for utility or savings.
So you have nearly 700 million people who own it, but aren't actively day trading it.
Yeah.
I want you, the listener, to think about your own perception of a crypto user for a second. We all have this stereotype in our heads of a 20-something day trader staring at 6 monitors of red and green charts.
Right, the typical crypto bro image.
Exactly. But if they aren't trading, the real user profile must look completely different.
Oh, it's entirely different when you look outside the speculative hubs. Look at the adoption data from India.
Okay, what's happening there?
Over 75% of crypto activity there is now happening outside of major metro cities. The average age of the user is rising, and women's participation has literally doubled.
Wow. And what's driving that?
Yeah.
Because a woman in a non-metro town in India probably isn't, buying meme coins hoping to buy a Lamborghini?
No, not at all. She's using it because the local financial infrastructure is either broken, too expensive, or entirely inaccessible.
Okay, give me an example of how she'd use it.
Say she's doing freelance work for a client in London. If she uses traditional banking rails, that international wire transfer takes 3 to 5 business days.
And the fees are usually brutal.
Right. She loses a massive percentage to exchange rates and intermediary bank fees. But by using crypto, that payment settles in 3 seconds, and it costs a fraction of a cent.
So it's being used for real-world things like remittances and payroll.
Exactly. Crypto is finally bridging the gap in global financial services where local systems have just failed. It cements its value way beyond mere speculation.
That makes total sense. It's becoming less Wall Street and more Western Union. And we are seeing the mechanics of that everyday utility improve in the U.S. too. Like, U.S. merchant acceptance of Bitcoin tripled in 2025.
And a huge part of that is the Lightning Network.
Right. The reports showed a 300% jump in Lightning payments, processing over $1.1 billion monthly.
Which is vital because the base layer of Bitcoin is notoriously slow and expensive for small transactions. The Lightning Network acts as a secondary layer.
Yeah, so for anyone who doesn't know, think of the Lightning Network like a bar tab.
That's a perfect analogy.
Right. Like, you don't hand the bartender your credit card every single time you order a single drink.
No, you'd be paying swipe fees all night.
Exactly. You open a tab, you order drinks all night, and then you just settle the final bill once at the very end.
Right. And Lightning allows thousands of people to instantly trade Bitcoin back and forth off the main network just like that.
And then it just records the final balances on the main blockchain later.
Yeah.
It's the only way paying for a coffee with Bitcoin actually makes mechanical sense.
But even with the Lightning Network, the real game changer for everyday utility and the true engine of this entire ecosystem right now isn't even Bitcoin.
No.
It's stablecoins.
Oh, right. The numbers on stablecoins that are absolutely staggering. In 2025, the market cap for stablecoins hit $305 billion. But the transaction volume, the actual money moving around the globe, was $33 trillion.
Just to put that in perspective, $33 trillion rivals the combined transaction volume of Visa and MasterCard.
That is insane. But wait, how does a $305 billion market cap generate $33 trillion in volume?
Well, it's because the velocity of the money is incredibly high. These coins are constantly moving.
Oh, I see.
Yeah, they've stopped being just a safe haven for crypto traders to park their cash between trades. They've turned into the actual rails for global commerce.
And that real-world utility isn't just happening in emerging markets with retail users. The biggest financial institutions in the world have taken notice.
They absolutely have. They are quietly rebuilding their back-end plumbing using crypto infrastructure.
Okay, let's look at Wall Street's involvement here because this completely flips the narrative. We see JPMorgan's JPM coin processing $3 billion daily.
And Visa itself has integrated the USDC stablecoin for settling transactions.
Plus, on the investment side, spot Bitcoin ETFs pulled in $25 billion in net inflows in 2025 alone. Total assets under management, or AUM, is sitting between $114 and $120 billion.
You've got legacy giants like BlackRock, Fidelity, and Grayscale dominating this space. They hold about 85% of all crypto fund AUM.
Which is over $123 billion. Between institutions and public companies, they now hold 12% of the total Bitcoin supply.
And that institutional appetite is expanding heavily into DeFi, or decentralized finance.
Right, the TVL numbers.
Yeah, the total value locked in DeFi protocols hit $277 billion before settling at around $189 billion, even after the market crash.
Let's break down what TVL actually means mechanically, because it gets thrown around a lot in these reports.
Sure, so think of total value locked like the capital sitting in the vault of a decentralized bank.
Right.
It's the aggregate amount of crypto that users have deposited into these smart contracts to provide liquidity. Because there is no centralized middleman in DeFi, the system relies on users locking up their own funds so others can trade, borrow, or lend against them.
And the fact that $189 billion remained locked up even during a massive market downturn, that shows the infrastructure has serious staying power.
Right.
The vault didn't just empty out when the panic hit.
Exactly. And a massive driver of that locked value is Wall Street bringing traditional assets onto the blockchain. We call this the tokenization of real-world assets, or RWAs.
Right. That sector reached $27.5 billion, which is a 2.4x increase. BlackRock's tokenized fund, called BUIDL, surpassed $2 billion on its own.
Mechanically, a tokenized fund like BUIDL is fascinating.
How does it work?
BlackRock takes U.S. treasuries, which are traditionally really clunky to trade and settle, and they digitize them into a token on a blockchain.
So you put in $1, you get a token that yields interest, but unlike a traditional treasury that operates on strict banking hours, you can trade that token 24/7.
Exactly. It makes the asset programmable. It allows Wall Street to move toward T0 settlement.
T0.
So in traditional finance, if you buy a stock or a bond, it takes 2 business days for the trade to actually clear and settle. That's T+2.
Oh, okay.
During those 2 days, the capital is tied up, bearing risk. By putting these assets on a blockchain, settlement happens in seconds. It cuts administrative costs, eliminates intermediary friction, and frees up billions in capital.
And they finally have the regulatory clarity to do this at scale. Regulations like the U.S. Genius Act and the EU's MiCA framework didn't just say crypto is legal, they established the actual accounting rules.
Right. They gave bank compliance officers the exact legal framework they needed to approve these massive infrastructure upgrades.
But here's where it gets really interesting.
Yeah.
The irony of all this just hits me. Crypto was invented to bypass banks, right?
Yeah.
In the wake of the 2008 financial crisis, it was a rebellion against the bailouts. But now, institutions like BlackRock and JPMorgan own a massive chunk of it. Did crypto defeat the banks, or did the banks defeat crypto?
If we connect this to the bigger picture, it's really an assimilation. Larry Fink, the CEO of BlackRock, is publicly calling tokenization the future of finance.
Right.
That means the dividing line between traditional finance and crypto has fundamentally dissolved. It's no longer a rebellion, it's an infrastructure upgrade.
Okay, so Wall Street is moving trillions through this plumbing, utility is up globally, the infrastructure is robust. But if this is all functioning so beautifully behind the scenes, why are the alarm bells still ringing?
Ah, the bear case.
Yeah, because we have Boris Brenda, the president of the World Economic Forum, explicitly warning that crypto remains a major global economic bubble. He categorized it right alongside the systemic risks of AI and mounting public debt.
It's a stark warning.
What is the WEF seeing that the banks are ignoring?
They are seeing the catastrophic risks that are still baked into the system. The underlying blockchain code might be highly secure, but the environment around it is incredibly hostile. In 2025 alone, $17 billion was lost to scams.
Or 17 billion.
Yes. And the mechanics of these crimes are evolving fast. Impersonation scams were up 1,400% year over year.
Wow. So scammers aren't really trying to hack the unhackable blockchain code anymore. They're just hacking the humans.
Exactly. And they are doing it with terrifying efficiency using generative AI.
Oh man, deep fakes.
Yep. We're seeing deepfakes of CEOs authorizing massive fund transfers, automated social engineering attacks, sophisticated phishing campaigns. AI-enabled scams are 450% more profitable than traditional methods.
And it's not just retail users getting tricked. Major platforms are still suffering catastrophic exploits. Take the Bybit hack in February of 2025.
Right, that was massive.
Approximately $1.5 billion was stolen in a single event. Think about that mechanically for a second. If a traditional regulated bank lost $1.5 billion to hackers, heads would roll globally.
There would be congressional hearings, panic in the streets.
Exactly. But here, it barely registers. It's just a Tuesday. How can Wall Street justify building the future of finance on an infrastructure where billion-dollar hacks are brushed off? How can we call a market mature when AI scammers are having a field day?
That is the exact contradiction the WEF is pointing out. Criminal tactics have shifted from hacking code to exploiting human error, passwords, social engineering, and it gets even more complicated when you look at the environmental toll.
Right, the ESG mandates.
Yeah, institutions care about that. And Bitcoin alone consumes 138 terawatt hours of electricity annually. That results in 39.8 megatons of carbon emissions.
Which is roughly the footprint of a mid-sized country, just to maintain the network.
Now, the industry data does show that 52.4% of that energy usage is now coming from sustainable sources.
But saying, half of our massive energy drain is green doesn't entirely solve the problem when the scale is that large.
No, it doesn't.
Especially when you factor in the e-waste. Bitcoin mining requires specialized hardware, right? ASICs. And they become obsolete very quickly as the network difficulty increases.
Right, the amount of electronic waste generated by constantly upgrading these massive server farms is a severe vulnerability.
It just feels unsustainable.
And critics argue that it makes the proof-of-work system fundamentally unsustainable in a world increasingly focused on climate targets. The WEF emphasizes that until the human vulnerabilities to AI and the environmental scaling issues are truly resolved, the catastrophic risks remain very real.
So synthesizing all of these sources, the Wall Street adoption, the utility emerging markets, the billion-dollar hacks, the WEF warnings, we have to answer our core question. Is the crypto craze of 2025 and 2026 a boom or a bubble?
Well, the data points to a bifurcation.
A split.
Yeah, the market is splitting into two entirely different realities. On one side, you have the speculative excesses, the meme coins, the pure hype, the unproven protocols.
That side still looks and acts exactly like a classic bubble.
Exactly. But on the other side, you have the underlying regulated, institutionally backed utility. The $33 trillion in stablecoins, the tokenized real-world assets, the infrastructure-solving remittance problems.
That side is undeniably a boom.
Yes, undeniably. And the forecasts for that foundational side are what really put this into perspective. Looking ahead to 2030, current models predict the ecosystem will cross 1 billion users by the end of 2026.
1 billion users.
And 86% of institutions plan to have crypto exposure. 60% of top U.S. banks are currently building crypto products. McKinsey expects that within 3 years, we will see $250 billion per day in tokenized asset transactions.
Those numbers are just massive. The long-term models from ARK Invest project a $16 trillion market cap for Bitcoin and an $11 trillion market for real-world assets by 2030.
And VanEck's base case scenario even models Bitcoin reaching $2.9 million per coin by 2050, driven entirely by its adoption as a global settlement network.
Wow. So the infrastructure is locking in regardless of what the surface-level price action does on any given day.
That's what the data suggests.
Which gives us the direct application for you listening right now. When you evaluate this space, ignore the loud, chaotic hype of the day-to-day price charts. Pay attention to the adoption curves, the developer activity, and where the institutional capital is actually flowing.
Because the real story isn't the price, it's the infrastructure.
Exactly. It's the invisible infrastructure being built underneath the entire global economy.
Which leaves us with a final, somewhat provocative thought that sits right at the edge of all this institutional data. We didn't really touch on this earlier, but it raises an important question.
What's that?
If Wall Street achieves its ultimate goal of tokenizing everything, making real-world assets like your house, your car, your creative royalties, liquid and tradable 24/7 on a global blockchain, what happens to the very concept of ownership?
Oh, wow.
Right. When the physical world is completely mapped onto a digital ledger and that parallel economy simply becomes the economy, who actually controls the keys to your life?
That is heavy. It fundamentally changes the relationship between you and literally everything you own. We started this deep dive talking about being strapped into a rocket, bracing for the whiplash of a chaotic market. But the realization here is that this isn't just a joyride we can step off of. The rocket is actually a completely new transit system. And regardless of how bumpy the ride gets or how many times the engines sputter, it is permanently changing the destination of global finance. Something to mull over the next time you tap your card or wait 3 days for a bank transfer to clear. Keep questioning the narrative and keep diving deep.